Here's a number JPMorgan has been publishing for years, and almost nobody actually internalizes. If you put $10,000 in the S&P 500 in 2004 and stayed fully invested for 20 years, you'd have over $71,000. But if you missed just the 10 best trading days over those 20 years, just 10 days out of more than 5,000, you'd have $32,871, less than half.
10 days cut your returns in half.
10 days. And here's the kicker. 7 of those 10 best days occurred within 2 weeks of the 10 worst days. The best days and the worst days are neighbors, which means the investors who panic sold on the worst days missed a recovery on the best days every time.
So by trying to escape the pain, they missed the gain.
That is the whole game. And right now, with the S&P down 7% year-to-date, the Nasdaq off more than 10%, and 50% of all stocks in the Russell 3000 sitting at least 20% below their highs, a lot of people are about to make that exact mistake.
So today we talk about what history actually says, not what your gut says, what the data says. Welcome to Trek4Wealth. I'm Avery, and he's Grant, episode 17. And we are getting into one of the most Googled questions in personal finance right now. Should I buy the dip? We're going to look at what buying the dip has actually meant historically, what it means today in this specific market, why market timing almost never works the way people think it will, and give you a concrete framework for what to actually do with your money right now, whether you're a buyer, a holder, or someone who's been sitting in cash waiting for clarity.
And spoiler alert, the clarity almost never comes. The question is what you do while you're waiting for it.
Let's get into it.
All right, so first, let's define terms, because buy the dip means something different to different people. To a day trader, it means something very specific and very technical. But for us, for Trek4Wealth listeners building long-term wealth, buying the dip means something simpler. Continuing to invest or even increasing your investment during a market downturn, rather than pulling back or going to cash.
So it's less about timing the exact bottom and more about not flinching?
Exactly right. And the history on this is overwhelming. Let's walk through the big one. Black Monday, October 19, 1987. The S&P 500 drops 20% in a single day, the largest single-day percentage drop in stock market history. The news is apocalyptic. Every financial commentator is saying the system is broken. What happened next?
It recovered.
The index hit its low in November 1987 and then climbed back to its pre-crash high by July 1989. 20 months. The people who stayed in or bought more were fine. The people who sold on October 19 and waited for stability locked in their losses and missed the entire recovery.
20 months to fully recover from a single-day 20% crash.
20 months. Now, the dot-com crash, March 2000 through October 2002. The S&P falls 49%. The Nasdaq falls 78%. This one was worse. It took the S&P about 7 years to fully recover. And the lesson people took from that was, see, sometimes the market doesn't come back quickly. Which is true, it was slow, but it did come back. And investors who kept buying throughout 2001 and 2002 at depressed prices captured enormous gains in the recovery.
Then 2008, which is the one that really broke people psychologically.
2008 is the one. Peak to trough, the S&P falls 56.8%. That is the worst drawdown since World War II. The index hits its low on March 6, 2009 at 666 points, from a high of 1,565 just 17 months earlier. It felt like the financial system was genuinely ending. And for regular investors watching their 401ks get cut in half, the emotional pull to sell was almost irresistible.
And the people who sold at the bottom in March 2009 never recovered.
Never fully recovered, because a year later, by March 2010, the S&P had already bounced more than 70% off that low. The investors who sold in panic missed the most powerful year of stock market gains in a generation. Then, COVID, March 2020, the fastest crash in history. The S&P falls 34% in just 32 days. And then, the fastest recovery in history. By August 2020, 5 months later, the index was back at all-time highs.
5 months to fully recover from a 34% crash?
5 months. And the investors who panic sold in March 2020 and then waited for things to stabilize before buying back in, they missed it. By the time things felt stable, the market was already at its highs.
Market does not wait for you to feel comfortable.
It absolutely does not. And this brings us to the single most important data point in all of investing, and almost nobody talks about it the way they should. Since 1928, there have been 27 bear markets in the S&P. Average decline of 33%, average length of about 9.6 months. And after every single one, the market went on to new highs.
27 bear markets. All of them recovered.
All of them. Not most, all. Now, here's the current picture. The S&P is down about 7% year to date. The Nasdaq is off more than 10%. 50% of all stocks in the Russell 3000 are sitting at least 20% below their 52-week highs. Morgan Stanley's chief equity strategist, the same guy who called the rolling recession concept years ago, says this correction is mature in time and price. He's not saying it can't go lower, he's saying the bulk of the damage is likely done. And JPMorgan's global market strategist is literally telling clients right now is still a good time to be taking risk. It's going to be a choppy, bumpy ride, but the best days tend to closely follow the worst days.
Okay, but I have to push back here because I know what people are thinking. They're thinking, yeah, but this time feels different. We have recession fears, we have oil shock, we have tariffs, we have a potential Fed policy error. What if this is the one that takes 7 years to recover?
That is exactly the right question to ask. And the honest answer is, we genuinely don't know if this will be a fast recovery like 2020 or a slow grind like 2001 to 2007. Nobody knows. But here's what we do know. The strategy of waiting on the sidelines for certainty has a terrible historical track record. Dollar cost averaging, putting in a fixed amount every month regardless of what the market does, has outperformed lump sum timing in the overwhelming majority of historical scenarios. Not because you buy at the bottom, but because you keep buying through the bottom without realizing.
So it's less about being smart enough to call the bottom and more about being disciplined enough to keep going?
The history of investing is really the history of discipline beating cleverness. Every time. Okay, let's talk about what actually to do. Because stay invested is good advice, but it needs more texture than that.
Wealth moves, let's go.
5 moves, and these work whether you're a long-term investor, someone who's been sitting in cash, or someone who's terrified right now. Wealth move number 1. Do not sell into the decline. I know we say this every episode, but it bears repeating because people keep doing it. Selling when markets are down locks in your losses permanently and almost guarantees you'll miss the recovery. Unless you need this money in the next 12 to 18 months, stay put. This is your long-term money. Treat it like it.
And if you do need the money in the next year?
Then it should never have been in stocks in the first place. That's the real lesson. Cash for short-term needs, invested assets for long-term goals. Never mix them up. Wealth move number 2. If you have cash on the sidelines, dollar cost average in. Don't try to time the bottom. Nobody can do that consistently. Instead, divide your cash into equal chunks and invest a fixed amount every 2 to 4 weeks over the next 3 to 4 months. You'll buy some shares at prices that turn out to be high and some that turn out to be low, and your average cost will land somewhere in the middle. That's the whole point.
And it takes the emotion out of it.
Completely removes the emotion. You're not deciding when to buy. You've already decided. You're just executing. Wealth move number 3. Keep contributing to your 401k. Don't pause it. This is the one people do that silently destroys their retirement. They pause contributions during market downturns to protect themselves. But what they're actually doing is buying fewer shares when prices are low, which is the exact opposite of what you want. Your 401k contribution in a down market is buying shares on sale. Keep contributing.
Pausing contributions in a downturn is like refusing to shop during a sale because prices look scary.
That is a perfect way to put it. Wealth move number 4. Rebalance, don't abandon. If your portfolio was 70% stocks and 30% bonds, and the stock decline has moved it to 60-40, rebalancing back to 70-30 means you're buying stocks at lower prices and trimming bonds that have held their value. Rebalancing is just systematic dip buying with a built-in discipline mechanism.
So rebalancing is buying the dip just with guardrails.
Exactly. It's the most underrated move in all of personal finance, and it takes 15 minutes a year. Wealth move number 5. Check your timeline, not your ticker. The single most destructive financial habit in a volatile market is checking your portfolio every day. Every day your balance is down feels like a confirmation that something is wrong. But if your money is invested for 10, 15, 20 years, a 7% drawdown in April 2026 is noise. Literally noise. Set a calendar reminder to review your portfolio once a quarter. And in between, don't look. Seriously.
Grant just told you to stop checking your phone. The most useful financial advice of the decade.
Here's what I keep coming back to when markets get scary. In 1987, people thought Black Monday was the end of the financial world. In 2001, they thought the dot-com crash meant tech was never coming back. In 2008, they thought the banking system was finished. In 2020, they thought a global pandemic meant the economy might never fully reopen. They were wrong every time. Not because the world was genuinely dangerous at those moments, it was, but because the market prices in fear faster than it prices in recovery, and then it recovers anyway. The people who built real generational wealth through these periods weren't the ones who called the bottom. They were the ones who kept showing up, kept contributing, kept rebalancing. Stayed the course through the noise and let time do the work. Preparing without predicting. Always.
That's Trek4Wealth. We walked through Black Monday, the dot-com crash, 2008, and the COVID crash, and what history says about staying invested through every single one. The S&P 500 is down 7% this year. The Nasdaq more than 10%, and 50% of stocks in the Russell 3000 are already in bear market territory. And the JPMorgan data is clear. Missing just 10 of the best trading days over 20 years cuts your returns in half. Don't let fear make you miss the recovery. Stay invested, dollar cost average, keep contributing to your 401k, rebalance, and for the love of compound interest, stop checking your portfolio every day. And as always, keep trekking.